Welcome to the global edition of our Net Group Investments Quarterly Highlights, where we profile some of the interesting takeouts from our recent fund manager workshop with our global best-of-breed managers. To hear the full fund manager presentations or for more information about our funds, visit the Net Group Investments website or access more of our content via LinkedIn, YouTube, and podcast channels. The second quarter of 2024 was very uneventful in terms of macroeconomics, mainly because the key central banks did not change their interest rates. We start this episode discussing the fixed income sector with insights from a renowned global bond manager who shares his concerns in the bond market. Meanwhile, global equity market seems to be propelled by a limited group of stocks. We gain perspective from a global portfolio manager on the present risks and opportunities. A contrarian value manager talks to us about his current research focus. Additionally, we delve into the future prospects for emerging markets. The episode ends with an analysis of economically significant real estate within a global property fund. David Roberts, co-portfolio manager of Net Group Investments Strategic Bond Fund, highlights why Q2 was such a dull quarter for global bond markets.
So why was the market so dull? Well, in reality, economic data was quite benign across developed markets. And indeed, investors and investment markets became more aligned with central bank thinking. To such an extent that most major markets, we would all agree really that one or two interest rate cuts would now be expected. But of course, as an active manager, even in a dull and boring market, sometimes we can still find opportunity. And cycles disconnect. We'll just touch on why we think that is. Now, the first thing, obviously, I think, is that active managers need opportunity. As I say, I think the last few months and the next few quarters will give us good opportunity. And that's because one of the key focuses for us is relative value in the global bond markets. We don't run a local fund. This is a global fund. And in that market, in the global market, we are seeing desynchronization, especially of monetary policy. For example, the European Central Bank and the Canadian Central Bank cut rates during the quarter. In the US and in the UK, the central banks want to cut, whereas in Australia, we might see a rise in the next month or so. And in Japan, we almost certainly will see interest rates going up in the next few months. So if we think about that specifically then, so Japan is quite a big part of the global bond market, and on some measures nearly 15%, but we have none in our portfolio. And we, like many others, are concerned that the Bank of Japan will be forced to raise interest rates, partly to defend a currency which has plunged against the US dollar, and partly because yields are too low for the rates of wage inflation that we are seeing in the Japanese economy. So from our perspective, it was sensible to avoid Japan. We move on to the next slide on our outlook, is the concerns across major bond markets about geopolitics, in particular, which political party will be left of centre, right of centre, will come into power in certain parts of the G7 economy. The top picture we're showing you there is two of the principal players in French politics, so Marine Le Pen and Mr. Mélenchon. Le Pen very much is seen as a hard right candidate, and Mélenchon pretty much socialist stroke communist. And the markets get very excited about whether left or right will win. But for us, we have to cut through the philosophy and just try to focus on economics. And whether the French left or right win, it is likely to be poor for French bonds, to lead to an increase in government spending, because strangely enough, both left and right actually have quite similar headline economic policies. So although France, to many people, looks quite a cheap way to play European bond risk, for us, that extra political risk means the extra value is just not enough. And if we move into across the other side of the Atlantic Ocean into the US, now, headlines, both economic and political, tend to be dominated at the moment by the impending runoff between probably Harris and Trump for the US presidential seat. But again, despite them having radically different moral philosophies, their economic policies are quite similar. Each of them is likely to spend a lot of money. They will probably vie for the title of tariff king. So policies that will likely stoke up inflation and create some investor angst. So a little bit like in France, those who are talking about global bonds having a phenomenal year through the remainder of 2024, we think are likely to be a little bit disappointed. And if we think then in terms of our best estimates on the next slide, then the final slide, when we think about that, what we're seeing from an economic perspective quite clearly is a slowdown, and I'm sure everyone is reading the same things that we are. So a slowing of inflation and a rise in unemployment. And that together with a stable in economic stability anyway, European Union should see some modest capital gains for bondholders. And we do expect global bonds in major markets to stabilize at slightly lower yield levels, so slightly higher levels of capital by the end of the year compared with where they are at the moment. So if we think about US 10-year bonds yielding maybe 4.1% at the end of the year, from current levels, that would give a capital gain of about 3% plus about 2.5% in income. So although we don't think it's a fabulous year for bond investors, then certainly for those who are looking to augment returns in an asset class, it should be the foundation perhaps for a broader portfolio. We think over the next 6 months, returns of 5 to 6% wouldn't be outrageous. Politics, of course, can get in the way. Harris or Trump or left or right in France, pretty much all of it brings with it fiscal expansion. Can the Federal Reserve, can the ECB, can other central banks cut under that scenario? That remains the big question today. So just to finalise then, from our perspective, the favoured part of the market is sovereign bonds, especially short maturity ones in the US. Within the corporate bond universe, again, the global economic backdrop's quite stable, so we like them, but they are expensive. So again, we prefer short-dated, especially in Europe.
Mike Moore, portfolio manager at Net Group Investments Global Equity Fund, emphasizes the factors influencing global equity markets during the second quarter.
Just going into the current market context, the one thing that I think is striking for most market participants is just how sort of narrowly driven the current market has been. And in terms of the kind of the market returns, they have been very polarized. So if you look at the bottom right-hand chart, market concentration is at kind of all-time highs. For example, technology in the top 1,500 companies is actually at levels we haven't seen since the early 2000s. Valuations are not wholly speculative, like, the likes of things like Cisco in the early sort of late 90s, early 2000s, but increasingly they are extended in certain areas of the market. I think an interesting point to note is that actually the majority of technology stocks haven't actually performed to talk to this concentration. And so if you look at the equally sort of weighted technology index and looking at the US top 1,500 universe on the top right-hand side, you can see it's actually underperformed the market ex tech. And so when you're looking at sort of some of the technology companies performing very well, there have been very specific sort of outperformers and very large companies that have done that as well. And in fact, only 30% of technology companies are actually outperforming the S&P over the course of this year so far. That's the lowest level since 2001 and 2002. So what does this mean? Well, the one thing that I think we can sort of safely surmise is that that there are sort of attractively positioned assets that are actually becoming sort of really good opportunities, whether that's in the broader market, but also in some of the sort of technology sector as well. And so we do think that it is actually a really interesting opportunity to actually deploy capital into new ideas. The one thing that obviously has driven up the kind of a specific subset of stocks is artificial intelligence. I mean, the opportunity is potentially, large, but when is a really key consideration. So if you look at three consultants, and I think you should take what they say with a very large grain of salt, but, McKinsey has sized the impact at 2.6 to 4.4 trillion. PwC have talked about 15.7 trillion cumulative impact to 2030, and Accenture say that productivity improvements could provide 10 trillion of global economic value by 2038. So a very wide range of forecasts and some very big numbers there. But what we really need to consider is just how long this will take to come through and how realistic some of these forecasts are. So the timing and the quantum of adoption is hard to predict. So we have been here before in the sort of the dot-com era in the late 90s. There was a lot of fervor about the internet, and then obviously there was the kind of the sort of crash in the early 2000s, and then kind of the internet age over the last 2 decades has seen remarkable increases in utilities for consumers. If you actually look a bit more recently in the public cloud space, and in fact, our investments in this area, things like Amazon and Microsoft are actually based on the public cloud business. That has actually been one of the strongest secular trends in technology for the past decade. And yet still today, only, sub 30% of the workloads are kind of still have actually moved over to the public cloud from 5% a decade ago. So there is a constant over-expectation as to how quickly some of these trends will play out. And we do think that there is a very long-term enduring trend in public cloud, but these things do take time to actually bed in and grow.
Steve Romick, the co-portfolio manager at Net Group Investments' Contrarian Value Equity Fund, discusses his current investment opportunity insights.
While the world isn't on sale today, we always want to be prepared for the moments in time when it is. To that end, we are always trying to improve our understanding of the better businesses around the globe. In addition, there are a number of sectors that are showing early signs of a cyclical downturn, and we have directed energy there. One example would be the agricultural sector, which should offer solid long-term growth, extending its almost 4.5% growth over the past 4+ decades. However, interest rates, climate change, lower ag prices, to name a few industry challenges, will create what we hope will be an opportunity.
Brian Coffey, portfolio manager of Net Group Investments Global Emerging Markets Fund, highlights what led to his fund outperformance in Q2.
So a summary of what happened during the quarter. What worked for the portfolio during this quarter was stock selection in China, in India, and in South Korea. And then in Taiwan, our overweight in that market and our security selection in Taiwan was also positive. We were underweight the GCC, as we have been for a long time, and that was positive. And during the quarter, the new elections in Mexico led to a devaluation, a sharp sell-off in the peso. And so being underweight in Mexico was also positive. There was a similar story in Brazil. We were underweight. That market was particularly weak, and our stocks weren't quite as poor as that market. So that was positive. And that translated on a sector basis to positive selection in energy, industrials, healthcare and communications, along with utilities. And our underweight in materials was also positive. We're expecting a weak global economy through to early 2025. The positive, we think that inflation is going to fall back and be back on track for most authorities' desired levels, which would lead us to expect rate cuts. The key, if you like, bottleneck in that process is monetary policy in the US. So we think we need to see the US cutting rates to allow more emerging markets to do what they can reliably do, which is to cut their rates. But at the moment, concerns about currencies are holding that back. Money trends in China are still weak, so we're cautious on that basis. There are positive trends in Brazil and Indonesia, but we prefer Indonesia to Brazil. And the reason for that is the politics. We think a lot of the exporters in emerging markets will be at risk from global weakness, and those are particularly concentrated in China and some of the North Asian markets like Korea and Taiwan. We think that the Indian relative is correlated to the yen, and we'll see a correction there if the US dollar weakens relative to the yen in particular. And monetary indicators for us suggest EM outperformance.
We explore the global real estate markets with Robert Promisel. He shares which sectors he is focused on.
We've talked about this in the past. We're really focused on a few thematics, and they're really sectors that are relevant to the economy. So residential and rental housing in particular is very important in a world where mortgage rates in the U.S. soared from sub 3% to 7% in 18 months. the ability to purchase a home has become much more challenged. And so we find that tenants are staying in rental accommodations longer. And we're also seeing that there isn't a real surge in supply in the markets in which we invest, primarily coastal apartments in the U.S., German residential, as well as single-family rental housing in the U.S. And so tenants are staying longer. Landlords are able to push rent a bit longer, a bit stronger. Retail, I've mentioned earlier, is really about necessity-oriented retail and also regional malls with a grocery anchor that are in markets with fairly limited supply, such as Australia or Europe and the UK. Healthcare, seniors housing is really driving that sector forward. We expect strong double-digit NOI growth for Welltower and for Ventas, another senior housing owner that we invest in. We expect double-digit NOI growth for the next several years. And the data centers is really a beneficiary of what we expect to be a medium to long-term trend of digitization. And then AI, as it becomes more prevalent in the economy over the next however many years it's going to take, that uses data centers a bit differently. It's much more energy intensive, much denser locations for cabinets, sightings for cabinets. As a result, site selection and the energy provision to that site selection is very important. And then logistics, it is going to be a long-term beneficiary of the drive towards efficiency for distribution. And so we continue to think that is a great place to invest over time as the economy grows.
You can access more information about all the fund manager workshops at Net Group Investments website, YouTube, or through our podcast channels on all major platforms. This has been your Net Group Investments quarterly briefing. Make sure to check back at the end of October 2024 for our next edition.